Most people have heard this advice. Do not put all your eggs in one basket. On the surface, that sounds wise. In fact, it is wise. But it is only half the story. Because you also have to ask whether the baskets move together. And that is where many investors get surprised. They feel protected because they are diversified. They feel prudent because they own several things. They feel reassured because their portfolio is spread out, but then stress arrives, markets break, and suddenly they discover that what looked diversified in calm conditions is not as protective as they thought. That is a problem I want to talk about. Because diversification helps, but diversification alone is not the same as real risk management. Now, to be clear, this is not an argument against diversification. Diversification does help. If all your money is in one thing, then a single mistake, a single event, or a single bad outcome can do a lot of damage. So, yes, spreading risk across different investments can reduce single asset risk. It can smooth outcomes. It can reduce the danger of one wrong decision destroying the whole portfolio. That is important. So, the issue is not that diversification is useless. The issue is that people often expect more from it than it can actually deliver. And that is where false comfort begins. Because diversification works well under normal conditions. The problem is what happens when conditions are no longer normal. Diversification only helps if the different parts of the portfolio do not all start behaving the same way at the same time. That is the hidden weakness. Because it is not enough to say, I own many things. The more important question is, do those things actually protect each other when stress arrives? Because owning many things is not the same as owning things that protect each other. That distinction matters. A portfolio can look spread out on paper and still be more fragile than the investor realizes. Why is that? Because during calm periods, different investments may behave differently enough to create the appearance of safety. But in difficult periods, that relationship can change. And when it changes, the comfort of diversification can become thinner than expected. This is where correlation risk comes in. Now, I don't want to make this too technical. In plain language, correlation risk simply means this: things that do not normally move together can begin moving together when stress becomes severe enough. That is the key idea. In stable periods, two assets may seem different enough. One rises, the other one is quiet. One falls a little, the other one holds up. Everything appears balanced. But in a crisis, the market often stops respecting those nice distinctions. In times of crisis, baskets that normally behave differently suddenly plunge together. And that is when investors realize that their diversification was not as protective as they had initially assumed. So the issue is not whether diversification matters. It does. The issue is whether the investor understands its limits. This matters because many investors quietly treat diversification as if it is the entire risk plan. They assume that if the portfolio is spread out, then the problem has already been solved. But diversification is only one layer. It is one tool. It is not a complete defense system. And that becomes obvious very quickly in moments of real stress. Because if your portfolio has no deeper risk management framework, then a crisis exposes that weakness almost immediately. Suddenly, the investor is no longer asking, am I diversified? They're asking, why are so many of these things falling together? I thought I was diversified. That's the painful moment. Not because diversification was wrong, but because diversification was mistaken for total protection. The false comfort is not in diversification itself. The false comfort is in assuming diversification alone is enough. And this is another reason I keep coming back to method. Because investing cannot be reduced to simple sayings. Simple sayings are helpful up to a point, right? Do not put all your eggs in one basket is helpful, but only up to a point. The don't put all of your eggs in one basket approach works until it doesn't. And it doesn't work in the precise moment that you need it to work the most, which is times of crisis. That's why slogans are not enough. Rules of thumb are not enough. A sound investing method has to think about risk before stress arrives. It has to ask harder questions, not just how many holdings are in my portfolio, but also what happens when conditions worsen? What happens when fear rises? What happens when assets that normally seem different suddenly begin moving in the same direction? That is method level thinking. And that is very different from simply repeating familiar investing advice. Diversification cannot replace risk management. Now, high earners are often especially vulnerable here because when a portfolio contains many line items, it can feel sophisticated, right? You have several funds, several positions, different account types, different markets, different categories, and that variety can create the appearance of control and sophistication. But appearance is not the same as resilience. A portfolio can look spread out and still be structurally fragile. Complexity is not the same as protection. And that's an important distinction for professionals, especially because capable people are often drawn to things that look advanced. But the portfolio is not safe simply because it looks advanced. It is safer only if the method behind it has thought seriously about risk. And if you want to understand what the sound investing method actually needs, watch episode 6, because that is where we will break down the traits that make an investing approach durable. Because this is really where the question leads. If diversification is not enough by itself, then what should the sound method actually include? So let me land this simply. Diversification helps, but only under certain conditions. And in crises, those conditions can change very quickly. That is why investors need more than allocation variety. They need a method that includes real risk management. So the question is not just, how many baskets do I have? The deeper question is, what happens when the baskets start moving together? Because that is when shallow confidence breaks. And that is when sound method begins to matter most. I'm Juan Casas of Beacon Wealth Advisory. I'll catch you in the next episode.